Let's talk about that big scary R word, which is recession. In 2023, everyone was throwing it around, expecting the US economy to crash because of rising interest rates. Many experts thought as the Fed kept raising interest rates to fight inflation, unemployment would spike and the US would be hit with a recession. But guess what? They were wrong. Inflation got cut in half, unemployment remained low, and the US economy kept going strong. Now here we are in 2024 and people are starting to worry about a recession again. Now why is that? Well, there are two main signs we need to talk about. The first one is called the Sahm rule. It's a simple way to predict if a recession might be coming, and it's based on an unemployment. Now the rule says that if the unemployment rate goes up by 0.5% or more from its lowest point in the last 1 year, it could be a sign that the economy is slowing down and a recession might be on the way. Basically, if more people start losing jobs after a period of low unemployment, it's not a great sign. Now in the US, the unemployment rate rose to 4.3% in July 2024 from a low of 3.4% in April 2023, and job creation for the month was also much weaker than expected. Now this increase in unemployment actually triggered the Sahm rule, and this widely followed recession indicator has accurately signaled every US recession since 1949. However, the rise in unemployment this time isn't just because people are losing jobs. Now, a lot of it is happening because more people are looking for work, like new workers migrating to the US who haven't found jobs yet. So while the Sahm rule is flashing this warning, we have to understand that this rise in unemployment is partly from more people entering the workforce, not necessarily from companies laying off workers like in past recession. Now let's talk about the second sign, which is Treasury yield curve. Now while this sounds complicated, let me break this down. Normally, long-term bonds pay more interest than short-term ones because investors expect the economy to grow over time. But right now, for over 2 years, short-term bonds interest has been higher than long-term bond interest. Now this is called an inverted yield curve and is usually a sign that investors are nervous about the future. Now when this happens, it often means a recession could be coming. However, despite this prolonged inversion, we haven't seen a recession over the past 2 years. So between the rising unemployment rate and the inverted yield curve, we've got two signals suggesting that a recession might be looming, and that's exactly why the big scary R word is back. But as always, it is important to keep in mind that every situation is different and the economy doesn't always have to follow the same playbook. And there are also a couple of indicators that show the US economy is actually doing pretty well. For example, the improved second quarter GDP showed strong growth mainly because consumer spending, especially on services, was up. While the pace of growth might slow down a bit, there are signs that the economy still has some staying power. Now, there are a couple of key things to keep an eye on. First, the US job data is coming out this Friday. This will give us a better sense of how the US economy is holding up. Second, the Federal Reserve policy meeting is happening on September 18th. Now, this is a big one. Now that the inflation in the US has cooled down quite a bit, there's talk that the Fed is considering cutting interest rates. A rate cut could help prevent a recession by making borrowing cheaper, which boosts spending and investments. Now, it's a big deal and it's a hot topic in discussion even around the Indian stock market. And of course, the next big thing to watch out is the presidential election. Now, that decision could have major implications for the US economy and global markets. So there's a lot happening that can swing things one way or another. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.